A measure of cheer as a closely watched Spanish bond auction goes down well with investors. The ECB keeps rates on hold, while the central bank assesses the impact of the policy measures it unleashed last year. President Mario Draghi insists the flood of cheap three-year money is helping the Eurozone, and he says the ECB is ready to cut rates again if necessary.
Monetary stance remains and will remain accommodative.
2012's first real test of investor appetite for debt from the Eurozone's battered periphery passed off successfully earlier today. Spanish and Italian spreads narrowed sharply after Madrid raised 10 billion euros, double its target. The government nonetheless still faces big challenges to meet tough deficit reduction goals. The next big test of sentiment comes Friday when Italy sells up to 4.75 billion euros, mostly in its three-year benchmark bonds. So could Rome follow Madrid's lead by selling more than initially scheduled?
Always a risk that you look desperate if you're just taking the shorter dated paper, and that's not great for your overall maturity profile. So there are risks involved in taking short dated demand if it's there, but at this stage of the year, why not?
Meanwhile, the Irish Prime Minister Enda Kenny says Europe must work to ensure a return to growth. Countries pursuing sound and sustainable economic policies need certainty of funding, he believes. Kenny also says bailed out Ireland hopes to return to the bond markets in 2013.
I'm not going to give you a specific date upon which Ireland will attempt to get back into the bond markets. We want to do it as quickly as possible.
Earlier in the week, the German Chancellor Angela Merkel made clear her view that securing a second bailout for Greece is the biggest priority for the Eurozone. Sources say a deal with private investors on a voluntary bond swap could be wrapped up in days. Heng Potts of Barclays Wealth says failure to reach agreement over Greece would not be in anyone's interest.
I think private investors also appreciate that if the Greek problem isn't solved, then they can't solve the wider European one. And the last thing they want to do is exacerbate the problems within the wider European context, because that means their potential for future losses across the spectrum of their investments would rise quite dramatically.
That's all for now. Join us at noon GMT every weekday for an update on all the big market trends and the movers. I'm Axel Threlfall. This is Reuters.